Welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. David, I think, are we in the second week of March? It feels like the fifth week of March. There's no let up, is there?
It feels like an eternity. I'm ready for my summer holidays already. It's tin helmet time. Markets are wild, so we need to talk about volatility today, I reckon.
We do. We're going to talk about what's been happening in US markets this week, but we're going to cover a couple of other topics which are sort of related, aren't we? What else are we going to talk about today?
We're going to talk about German stimulus. Sounds dry, but this is something huge. And we alluded to it a little bit a couple of weeks ago when we talked about the next steps of Germany. It's almost as if the German establishment heard the podcast and uncharacteristically, without any bureaucracy, implemented or at least proposed one of the largest stimulus plans we've seen ever.
Yes, certainly, fairly substantial and on a par with the kind of amount that was raised when Germany reunified.
Exactly. So let's talk a bit about that. And then, I don't want to stray too far away from what's going on in markets, but there's a nice story in Japan about Japanese equities. And I think let's get into that as well.
Okay. But before that, quick fire numbers round. You go first, David.
The risk of being really boring and keeping it very contemporary. My number is $4.5 trillion. And that is the market cap of the S&P 500 that's been erased from its all-time high very recently. So, it's buckle up time, tin helmets. And, I want to put this into context as we get into our first section, because anyone that's been around for a while and been invested in markets knows that these kind of events are actually quite regular. So we'll get into what's happening and why and put it into context. But I thought when you put market sell-offs into monetary terms, it really makes the point. 4.5 trillion.
Yeah, that's a lot. And I say it's not to dismiss or say, it's just another correction. They happen every year. I mean, it's a meaningful correction and one that we need to sort of take seriously. Okay,
what's your number?
My number 720,988.
Wow, we've flipped, haven't we? I used to have the really specific, random, esoteric numbers. Now you're choosing them. I have no idea.
Well, it relates to one of our topics today, and it is the number of births in Japan in 2024. It's a record low. It's the lowest level since records began 125 years ago.
Wow, that's amazing. Also, go on.
I was going to say, and it's a 5% drop on 2023.
Wow, that's incredible. I mean, Japan, obviously, at the other end of the scale, has, I think, a disproportionate number of centenarians. I think around 100,000 people who are over 100 years old. And from memory, most of them are concentrated in the south, in Okinawa and around there. It's quite amazing.
Yes, but actually, they had 1.6 million deaths last year, which meant that the population shrank by almost 900,000.
Exactly, and there's not a huge amount of immigration as well. It's anyone that's been to Japan, I go quite regularly, just needs to go out into rural Japan to see such a stark contrast with the cities. Quite incredible.
Yeah, no, I love the place. I haven't been in a long while. Anyway, let's get back to what's happening at the moment. We're going through a period of transition, possibly, are we? To quote the current president?
Well, yeah, that's very diplomatic, I think. Look, markets are just really messy right now. I think that's my very superficial description of it. I mean, investors are just scrambling to find out whether this turbulence is a buying opportunity or the start of something deeper. And I think what's most remarkable about what's happened is there's no single catalyst to this, right? So actually, if you go back and look at data, it's hard to really pin what's happening on anything in particular. So for investors that perhaps aren't glued to their market screens every day, do you want me to just put some numbers on what's been going on?
Yeah, let's do that.
So cut to the chase, the S&P 500's had probably one of its worst weeks in years. It has had one of its worst weeks in years. It's dropped about 2.7% in a single day. Just yesterday, Nasdaq down 3.8%. And you've seen tech stocks get hammered. We've talked on the pod about the volatility of firms like Nvidia and Tesla. They've had some extreme volatility. And it's not just equities. In fact, if you go into the investment grade markets, you saw them pretty much glue up and freeze. And so what does that mean? Well, you had I think about 10 issuers delaying bond sales. So what's that telling you? It's telling you that there's this real sense of risk aversion creeping in. So why now? I would encourage everyone listening not to get too excited about catchy slogans that are going around. I saw one just on the news this morning talking about Trump session or a Trump slump. I think that's too superficial, right? There's no sudden piece of bad economic data. There's no central bank surprise. There's no earnings disaster. I think what's happening here is investors are just waking up to a reality that's actually been obvious for a number of months. The risk premium needs to be priced into the markets. US policy risk needs to be priced into markets.
Do you think investors were maybe guilty of being a little bit exuberant, perhaps following the elections, and perhaps now they're having a little bit of a reality check, prompted perhaps by the interview with the president over the weekend, in which he didn't rule out a recession in the US, and perhaps investors are now getting a little bit concerned?
Yeah, and I think we live in a world that's hypersensitive to language, and we've developed that through various technocratic institutions over the last couple of decades. So central bankers, as an example, are masters at how every single word that they deliver, it's very carefully crafted to manage expectations. And I think when it comes to politicians, whoever they may be, they perhaps don't abide by the same stringent rules of speech writing and this kind of sensitivities to words. So you're right. I mean, part of this is a reaction to the comment that when it was about a US recession, that I think the current president said, the direct quote was, I think it should be great for us. Now, I wouldn't hang too much off just that one comment. Like you said, what this is just the seesaw between what's rhetoric and what's real. So remember, what have people been talking about and concerned about for some time now? The effect of tariffs. We've talked about a lot of that on the podcast.
Yeah.
But then this idea also of US policy mix tightening. So markets have become very comfortable with deficit spending and low rates over the last decade. And now they're facing this idea that actually there could be spending cuts and a Fed that's not in a rush to come in and cut and help out. So that then has read across to things like the dollar and the dollar's role in global capital markets and the uncertainty around that. So it's a real wild card that the market's trying to grapple with.
I mean, we're saying there's nothing there's not one catalyst that we can hang all this on. There has been some negative sentiment data, which is sort of survey led, which, as we talked about on a recent episode, is not surprising when there's so much uncertainty, and the policy pendulum swings from one side to the other, and we have tariffs on and tariffs off. But we had the non-farm payrolls, the US jobs report out on Friday. I mean, that wasn't hugely negative, was it?
No, it wasn't. And I think your point about survey data and sentiment data is really relevant. So if you go and look at US household survey data, it's in a worse position now than it's been since November 2023. So what you're seeing is US households saying that in 1 year's time, they think that the economic situation they're in will be worse off than today. But go back to November 2023, that was an excellent time actually to be an equity investor. Actually, 2024 didn't pan out that way. So it just shows you these survey data are just a sounding, a reading at any particular moment in time, and very much influenced by just what's going on in politics and socially. They don't necessarily reflect economic fundamentals. So the other data point that people got very excited about was the Atlanta Fed's GDP nowcast. So the Atlanta Fed produces this. They try to infer what future GDP is going to be in advance of the official numbers coming out. Now, that nowcast figure was negative and made everyone stand up and say, well, is the US economy actually shrinking? But interestingly, I picked up on an interesting chart, which I posted on LinkedIn, about how American gold imports surged late last year and in January this year. Absolutely enormous imports of gold for various reasons, which I've talked about. But that gold import figure actually broke the Atlanta Fed's GDP nowcast model. And the creator of that model has come out and said, actually, things aren't as bad as the model suggests. In fact, things are relatively benign and positive. It's just this giant gold import figure broke the model. So back to this point, there is no fundamental piece of macro data that is looking like it's deteriorating at this stage.
Well, I mean, and further to that, I saw that Goldman Sachs have revised their forecasts for the rate at which the US economy will grow. They've gone down from 2.4%, I think, to 1.7%. It's still growing. It's just not going to be growing as much as perhaps they'd originally forecast.
You're 100% right. You can get these figures from a number of institutions, many of which we work with here at Coutts. And the point is that no one would dispute that tariffs and some of these policies don't impact growth or inflation, but these aren't binary outcomes. We don't just turn from slow down growth into recession on a dime. It's an oil tanker that changes direction slowly. And, most of the investment bank research, which I've talked about a lot on the pod, suggests that these policies create headwinds to growth and slow growth, and they also create slightly sticky impulses in inflation, but they don't wholesale change the trend overnight.
Yeah, I think that's a fair point. I have got a bit of a challenge for you. Now, obviously, there is a risk-off mood at the moment in markets, or certainly at the time of recording. I mean, that could change, certainly in the US. And we've talked about, sort of safe havens. And you've said in the past that the US dollar can be a safe haven, even when the issues or the concerns are around the US. Now, we're not seeing that at the moment, though, are we? We're seeing the euro actually is strengthening against the dollar.
Yeah, exactly. The exception, which sort of disproves the rule. But generally speaking, when crises happen, even if those crises originate in the US, the dollar and US assets tend to outperform other areas. I mean, this is quite a unique situation. But you said the word sentiment there, which was key. What we're talking about here is sentiment. We're not talking about any fundamental repositioning in markets yet. Okay, you've seen European funds have inflows. You've seen inflows to euro assets, but these come from a very low starting point. The US dollar and US assets still dominate global markets and will do for the foreseeable future. We're talking about short-term trends and sentiment here. I mean, the point really here is I would differentiate investing from trading. So the investment argument about dollar assets and US earnings hasn't yet changed. Yeah. But the trading environment about sentiment, like if you're a trader, so investors are struggling to make sense of all this noise. Traders are absolutely thriving. Okay. So, a one statement at the moment can create massive volatility and huge profit and loss either way. So if you're trading in volatility, I suppose the most extreme expression of that is crypto markets. So what's happened, talk about safe havens. Remember what the crypto advocates say. They say this is our safe haven asset. It's our harbor in a storm. What you saw when we talked about the crypto reserve just last week is crypto assets rally and then immediately sell off into almost free fall just within a few hours. You had prices up 70% and then down 30%. And traders who are trading that make money. But if you're trying to invest, it's absolutely impossible. And this is the point. The point is that we're in now a period of quite extreme volatility, or certainly heightened volatility. And we can expect that for the foreseeable future. We're not transitioning yet into a different economy, but I think the next coming weeks and months will give us a sense of what direction the data is going. But I don't sense that right now anything has really changed other than everyone is now trying desperately to pricing something that is impossible to price.
Yeah. I one last thought on this. I wonder whether, I think the president is meant to be meeting with sort of corporate America this week. I wonder whether we'll see, because one of the other sort of key policies that was announced at the time of the election were corporate tax cuts. I wonder if we'll see those now coming through much more quickly in a bid to stimulate the US economy. We
could do. And I, again, like when we talked about the crypto strategic reserve just last week, the devil's in the detail here. You've got to be able to pass law okay, there's a reconciliation process that can be done to pass various budget items, but ultimately Congress needs to get behind a tax plan, and that requires compromise and negotiation. So where I see us at the moment is, yeah, okay, everyone is reacting almost on an intraday basis to rhetoric and individual words and sentences. The data hasn't changed. Meaningful fiscal change will require congressional approval. So there is a process that needs to go through, which could bring some order back into markets. So instead of us just reacting to individual executive orders, we go through the sequence of checks and balances. And there's a lot of column inches written about this, the propensity for this to be a constitutional crisis. Is it not? I would expect over the coming weeks us just to go back to the normal order of fare and trying to pass law ultimately.
Yeah, and as you say, I think that's a very important distinction between the mindset of a trader who is probably reveling in all this at the moment, and the mindset of an investor who, it's I don't want to be trite to say thinking long term, but that's what an investor should be doing, rather than reacting to the push and pull of various different headlines and as I said before, that pendulum swing of policy where we're going from one side to the other on a day-by-day basis.
Yeah, you're absolutely right. I think when it comes to investing, you should remember, drawdowns that we're seeing right now are relatively frequent occurring events. Uncertainty right now is very high, and markets really don't like uncertainty. They like it almost less than a recession. A recession can be priced in and understood, and then you start talking about the policy response and coming through it. Uncertainty just absolutely kills market sentiment. So it's going to be about economic fundamentals and earnings. And right now, I wouldn't get too hung up on trying to call this a pithy, what did I say earlier, a Trump session or a Trump slump. I think that just trivializes it. I think this is almost a mini crisis in uncertainty.
Yeah. Okay. And we'll keep watching this, and we'll be coming back to this, I'm sure, on a weekly basis. All right then. Well, let's turn then to Germany. So another big sort of announcement in the past few days was this, as you said at the beginning, this amazingly quick announcement that they're going to ditch the debt brake for defence spending. And also there's going to be this special purpose vehicle for spending on infrastructure, 500 billion euros, which had the most remarkable effect on German bond markets, didn't it?
Well, absolutely. And I think, why is this relevant? Well, for those of you out there listening that have heard us talk at the bank for a couple of years, you'll remember us talking a lot about the CHIPS Act and some of the post-COVID stimulus programs, the fiscal stimulus programs that happened in the US, which were responsible for massive moves in markets over that period. What we're seeing from Germany is in a similar order of magnitude. And we talked a lot on the pod just last week about Germany, 2 weeks ago, about Germany's economy, the size of Germany's economy. And one of the features that I drew out is how Germany is generally slow and bureaucratic and resistant to big moves. But I think we just shattered that assumption, right? Because like you said, this is something that we haven't seen any time in Germany's modern history. It's been preaching fiscal discipline while the rest of the world spent, and now they've basically ripped up that rule book. So you mentioned 500 billion. Let me put some of that into context, right? Germany, since I think 2009, has written into its own constitution a borrowing limit of 0.35% of GDP. So running a government deficit, of new borrowing at 0.35% of GDP. That's tiny. And right now, the US are running about a 6% deficit. That's 18 times larger relative to GDP than where Germany is. And Germany has just scrapped that now and said, right, 500 billion infrastructure plan, as you said, over 10 years. That's 12% of GDP. Unlimited defense spending. We all know why that is. And any expenditure above 1% of GDP on defense will be exempt from these. And importantly, allowing German states to run higher deficits. Now, that 0.35% GDP deficit that Germany has limited itself to was at the federal level. Actually, at the state level, they've expected a balanced budget. And Germany's now just said at state level, you
Yeah.
guys can go and run higher deficits. So this is a wall of expenditure and capital which is going to go into the German economy.
Now, there have been, I mean, Germany's experienced, 2 years of stagnation, essentially. I saw some saying that this is going to potentially double the rate of growth for Germany.
Yeah, I mean, Germany's had anemic growth, and if you increase deficits to that 3 to 4% of GDP range, not as high as even the 6% of US GDP, that's a tectonic shift in growth expectations. And look, the market reaction to that was almost instantaneous. So bund yields surged. I think you alluded to that. That's the biggest one-day move in German bonds since reunification in 1990. Yeah. So absolutely enormous. Euro strengthening sharply, and there's lots of reasons for that right now, but this was a principal driver. And Europe's whole role in global capital markets as a consequence of just this announcement is starting to shift.
Yeah. And it brings us back to one of your favorite topics, industrial policy, because what we're going to see presumably in Germany is we're going to see, with this unlimited spending on defence, we're going to see a shift away from perhaps some of the declining sectors into defence manufacturing, because I did read that actually most arms imports to EU NATO states come from the US, don't they?
They do. I think it's about 60% of imports come from US companies. And this announcement is almost on a 2012 Draghi levels of unexpected sort of announcement. Okay, so this is not the kind of traditional German gridlock that you get. I mean, look, this isn't yet ratified, so you've got a wild card in there that in the German parliament, the Greens hold the balance of power. So I would expect there to be some moderation in where this expenditure goes, but you can't escape from the bottom line number. I think what it means is that you've now got Germany as a major bond issuer, right? So this expenditure will need to be financed, and that if you look at how much German debt has been issued over the last decade, it's basically been declining. Germany, for large parts of that period, has had negative interest rates on its debt as a consequence. So if Germany becomes a major bond issuer, that creates an alternative for reserve managers that want to kind of slightly diversify away perhaps other regions. And these knock-on effects that you just described, about defense spending, etc., that could percolate across Europe, not just from Germany. I mean, yes, we've had 60% of defense imports coming from the US, but there are lots of French and even German sort of, defense manufacturers or aerospace manufacturers, and you would expect a huge ecosystem now to develop around this expenditure.
But as you say, there is a caveat, and that is that we don't yet have the new coalition government. I think the latest predictions I saw that possibly won't happen until Easter. So there will be a job. So Friedrich Merz will be sort of attempting to get this through the existing parliament. But as you say, the Greens may well resist. We'll have to see what happens. But interesting developments for the largest economy in Europe.
Yeah, I think we're thinking of pushing. Well, they're thinking of pushing this through before March 25th and trying to lock it into the current parliament before those new political dynamics take over. But let's see. In any event, there's the will to do it, and that my point on industrial policy and on the need for targeted sectoral public expenditure across Europe was all about having the will to do it. We've now got the will to do it. It's just the mechanistic process of executing it. And I think, I'm not going to say that's all just detail, but I think that's the easier part of this.
Yeah. Okay. Let's come then to our final country, Japan.
Yeah, we're doing a bit of a tour of the world, aren't we? Why did I want to talk about Japan? Look, I'm not trying to divert all of our attention away from volatility in US markets here, but there's a structural story in Japan that is easily overlooked. And we talked obviously a lot about Europe and Germany and about the structural issues there. And I thought we should revisit Japan and talk a little bit about what's been going on. Now, a couple of times on the pod, we talked about share buybacks last year in Japan, about them just accelerating and up about, I think, 70% during 2024. And this is about the nature of the Japanese equity markets, that Japanese companies are buying back a lot of their share capital They're becoming more efficient at the corporate level, and capital is being allocated now in a different way in Japan, and I think that's making foreign investors take notice. So you've got activist investors in Japan forcing Japanese companies to restructure. I'll give you a great example.
Yeah.
So Tokyo Gas and Electric, a utility company, happens to own one of the most famous hotels in the world. In fact, it's the Park Hyatt Hotel in Tokyo, the hotel that was used in Lost in Translation.
Yeah.
Why is a gas company owning a hotel? They've got this vast real estate portfolio that happens to include that hotel that's worth about 10 billion. And the arguments from a lot of these activist investors is just sell this hotel, focus on your core business, return the cash to shareholders, focus on energy, which is what your business does. And this is a kind of microcosm of a much bigger shift that's going on in Japan. Japanese firms are monetizing assets and cutting these sort of cross shareholdings they have, and ultimately buying back share capital and rewarding investors. And years ago, I remember an anecdote from a client who was a big private equity investor in Japan, who said he met the CEO of one of these huge Japanese conglomerates of like 200 firms and said, if you had to sell one of your businesses, if I had to force you to sell one of your businesses, which one of your businesses would you sell? And the answer was, well, I couldn't possibly sell any of them. They're all important. And that was very much the mood in corporate Japan for decades, and that has changed now markedly over the last year. So you're seeing share buybacks. You can see that in the data, how it's trended up. You've got the Japanese economy generating inflation for the first time in a couple of decades. Real Japanese households are returning back to domestic equities, and hitherto they've been allocating to global equities. Wages are rising. Japan, for the first time, is moving towards nominal real growth. So I think this is really interesting. And given all the other things we've talked about today, if you think of Japan at a corporate level shifting how capital is allocated and firms are run, you've got Germany following through on its spending plans. You can see that there is the possibility that global capital flows start looking just other parts of the world in a way that we haven't seen recently. So you get this idea of what's called regional dispersion. You get different regions performing differently as opposed to just one global synchronous story.
Okay, well, that sounds great. However, if we go back to our first topic in the US, I mean, Japan could be hit by US tariffs. I mean, there's a proposal, was it 25% on steel and aluminium imports, plus a 25% levy on car imports that could be brought in next month. And we talked before, when we talked about tariffs, and we talked about it's not just the one and done, it's the complex production networks where parts go backwards and forwards across the border. And certainly for Japanese car makers, that's the case, isn't it? Where they rely on movement of parts between the US, Mexico and Canada. So they could be really hit if we get a tariffs are back on again announcement.
Yeah, look, it all depends on what bilateral tariffs are applied. And many Chinese firms, as an example, actually located themselves in Japan to bypass previous tariffs. You're right about steel and aluminium imports. I mean, Japan's a major exporter of those. So, you've seen I think it's Yojimuto's recent visit to Washington was widely expected or understood to negotiate Japanese exemptions from those tariffs. So, Japan is a strategic ally of the US, so is Canada to that extent. So I don't know. I would imagine there's an active process in Japan to negotiate, stable trade relations with the US. But even without that, Japan has quite a diversified export market. It's not just steel exports to the US. So yes, it is challenging, and Japan needs to navigate this global trade environment the same way as everyone else does. But I still don't think it changes that story at the corporate level in Japan, that sort of microeconomic story, which in terms of how firms are run. I think when we talk about diversification of supply chains and bilateral sort of trade issues, So, this is a trend that has been evolving since about 2018. Companies have been diversifying away from individual bilateral exposures by locating factories in multiple countries, and that trend will just continue. I think that you'll continually see Japan lobbying for exemptions. It may happen, it may not, but this is the world we're living in now, where you get high-level sort of policy announcements and then individual exemptions negotiated.
Certainly, I did see that Japan is the largest provider of foreign direct investment into the US. I think the most recent figure I found was $783.3 billion in 2023. So I think there's an important relationship there between those two countries.
Yeah, absolutely. And I mean, it was, Japan has been investing a huge amount of FDI into the US for many years, and most recently tried to obviously acquire a huge steel manufacturer in the US, and that got very political and was blocked. But I don't think that anything has changed yet. Tariffs are an issue that are beyond just Japan. They apply equally to potentially the European Union, the UK, and other regions as well. So I think the devil's going to be in the detail. Let's see. I think let's keep close to this topic. I said we would be talking about tariffs all this year. We talked about it last year as a consequence. I think it will be a topic for months to come.
I think what's interesting for me is that we've talked about 3 different countries with 3 different economic stories to tell at the moment, and they're constantly evolving stories that we're going to be keeping a very close eye on, and we'll be making sure that we're keeping you up to date as far as need to know is concerned. Thank you very much, David. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you for listening. Until next time, we'll need to know. Bye for now.